With 2019 becoming ancient history, it's time to look forward to 2020. And with that, analysts are already forecasting which will be the most profitable S&P 500 companies in the new year. Overall, S&P 500 companies are expected to earn about $1.5 trillion in 2020. Astonishingly, a quarter of that will come from only 14 companies. That, according to an investor's business daily analysis of data from S&P Global Market Intelligence. So, what will be the most profitable companies in 2020? Predictably, the tech sector with Apple, Microsoft, and Alphabet or Google will settle in at numbers 1, 2, and 3. And the rest? Well, let's take a look. If S&P 500 companies deliver $1.5 trillion in profit as predicted, that would be an increase of about 7.5% from what they made in 2019. Using an earnings per share and market cap weighted basis, S&P 500 companies are expected to post 11% higher profit in 2020 versus 2019. According to Investors Business Daily, S&P 500 companies in the technology select sector are the ones to watch next year. The 69 tech companies in the S&P 500 together are expected to report net income of about $300 billion. That's more profit than any of the other 11 S&P 500 sectors. Only stocks in the financial select sector come anywhere close, with total expected net income of $273 billion in 2020. Looking at expected 2020 growth on a market cap earnings per share basis, stocks in the healthcare select sector are expected to record 25.1% higher profit in 2020 according to S&P Dow Jones indices. As shown in this chart here, that will exceed the 22.8% expected earnings growth in 2020 of the S&P 500 energy sector. According to the analysts, Apple will continue to be the biggest S&P 500 profit machine next year. They estimate that Apple will make $58.1 billion next calendar year, topping Microsoft's $42.9 billion of expected profit and Alphabet's $38 billion of net income during that time. On an adjusted earnings per share basis, Apple's profit is estimated to rise about 12% to $13.59 per share in calendar 2020. Technology is anticipated to be the S&P 500's profit engine. However, financials are expected to be close behind. On the list is JP Morgan Chase, which is seen posting net income of $31.7 billion next year. Berkshire Hathaway isn't seen boosting profit much in 2020. The analysts are calling for just 3.8% growth in Berkshire's 2020 earnings per share. But when your company is expected to make $26.9 billion next year, that's still enough to make you the fifth most profitable company in the S&P 500. And I have gone through each of these companies. Some have shown up in recent videos as well. And my pick for 2020, regardless, is Berkshire Hathaway. However, my selection is based on a few different measures. First, Berkshire is likely the most diversified company on the list. Further, Berkshire has a war chest of well over $100 billion waiting to be deployed. Even if part of that money is deployed, that could change the overall picture quite dramatically. Lastly, I have looked at the charts for all of these companies, and I prefer Berkshire because it's in the early stages of its move. So let's take a quick look at the chart for Berkshire Hathaway. And we're looking at the 20-year monthly chart on Berkshire Hathaway. This is the A shares, and the symbol is BRK/A. It could also be .A or -A, depending upon your platform. Now, for disclosure purposes, I do not hold any shares of Berkshire Hathaway Class A shares at this time. However, I did own Class B shares, which are much more affordable. but I liquidated those not too long ago, and I'm looking to get back in if the opportunity arises. Now, looking at Berkshire Class A shares, we're nearing a record that we had set there in late 2018, so we're not too far off. Now, it is elevated above the 20 and the 50 EMAs, and I'm looking for perhaps a pullback back down to maybe the 20 EMA, at least on the B shares. But let's take a look at the MAC. This is the main reason that I'm interested in Berkshire over any of the other companies. Berkshire is in the early stages of its move, in my humble opinion, whereas all of the other companies are already maturing in their formations. Now, Berkshire Hathaway, again, like we've looked at with regard to the S&P, this formation here is very similar to the formation that we saw back in 2015 and 2016. And if things go according to plan, once the fast line moves through that slow line here, and if it accelerates as it did in 2017, we'll have a pretty good move in Berkshire Hathaway. I can't say that's going to happen, but so far things have looked pretty good. And you can even go back here and see another example in the 2011-2012 time frame. It looks real good. That trend line goes on up like that. So I think things are going to continue, as I do for the S&P. Now, things can always change. I can change my opinion on a dime if certain circumstances do play out. So always keep your eye out. Now, looking here at the histogram, things look good, nice basing, and it looks like it's just about to go through that zero line. Here into the price rate of change, that bottom is forming nicely as it did back here. You can see that echoed also in the RSI, as well as in the stochastics and in the Williams. So everything looks fine. Now the Williams looks a little bit different here in this basing and bottoming than it did back in 2015, 2016, but not everything is perfect. Going back up here, I'm actually more interested in the way that the MAC looks, and to me, it looks nice. Back up here to the price chart, one more look. I'm not going to be buying the Class A shares. It's too expensive. I'm going to need to borrow some money from you guys to help me out. But I will be looking at Berkshire Class B shares. But as usual, if you look at Class B shares or Class A shares, conduct your fundamental analysis. And so for today, that's Chew Dog Charts. Thank you.